All right. Good morning, everybody. So we have a few folks maybe still joining. I'm just getting a little like feedback or something there, I think, from the few folks that are on the phone. So I've just muted those. I hope that didn't kick you out. I think we should be good. We should. Okay, so here we are, guys. Next week, last week of class. So kind of as things continue to unfold with the pandemic, time still flying by. Still waiting to hear some more news about. I know at least here in Ohio about our stay in place order. My wife told me this morning that a neighboring state to Ohio just extended their stay in place order through most of May. So I don't know. This thing continues to kind of unfold. But how are you guys doing out there? You guys doing okay? Probably ready for this semester to be in the books, huh? Just can't quite seem to get it behind us fast enough, maybe. At least that's kind of a little bit how I imagine I feel. Yeah, yeah. I mean, like anything, right? Yeah, yeah. I mean, if I guess quite literally, Luke, there is that like if it doesn't kill you, it makes you stronger, as they say, right? But I know some days it might feel like it might, come to that. But stay strong. We're closing in. We're making our way. Okay. And I know this is only one of the many classes that you have. But I guess I'd just say, stay the course, keep the faith. We'll get through this thing. We'll come out on the other side, hopefully better off because of it. Again, I truly hope, this is for some of you, this is the only accounting course you're going to have. For some of you, you're also going to be required to take the managerial 228 course. I sincerely hope that a lot of you guys are getting registered for that class, because it would be great to see you guys back in the classroom come August. I had no idea how much that I'd actually miss being in the classroom with you guys. This virtual setup has been working out, kind of getting us by, but we can't beat the in class interaction. So just know, I'm missing you guys, as crazy as that might sound. But just a few things kind of as we look ahead to our schedule. Right now, our final exam is scheduled for Tuesday of exam week at 1 o'clock. But again, because of the whole online virtual learning, everything else, what I would like to do is that I've heard that some of the other classes, quite a few other instructors seem to be moving their final exams. And what they've been doing is moving them up in the week. And so what I would like to do is take our final exam and move it back. I'd like to move it to Thursday of finals week. I also like to change the time just slightly to late morning, just so it's kind of a little bit closer lined up to when we would normally meet. Again, this test is basically just our third test, so you'll have about an hour and 20 minutes timed, but it'll open up at 10:30 on that Thursday. I don't. I hope that doesn't create conflicts for folks or further complicate that week of finals week. I'm trying to as I said, trying to make it more accommodating, try and break up your week a little bit, and kind of stretch that out so you can kind of still focus on kind of take smaller bites during that finals week. So I know some people may not be available during that time, so I'm going to be posting a Moodle announcement when we wrap up here this morning. And if that does create any conflicts whatsoever, please just respond to that email or that Moodle announcement, and we'll kind of go from there. The other item on our agenda for next week is our Tiffanopoly. That's what we'll be doing in class on Tuesday next week. So just a few things on that, just so as you start to see things get circulated over the weekend and early next week, you'll kind of have an idea of what's coming our way. So I have broken the class up into 4 different groups. So you will be assigned a group. It's still an individual assignment. We're 70 points for the semester, so almost 10% of your grade. But it's still an individual assignment. So you'll be on a team, but you'll be needing to keep track of the transactions and the everything there for the group that you've been assigned. So it's not a group assignment. You're just going to be assigned to one of the 4 groups, 1, 2, 3, or 4. So I will be posting here. Let me just pull this over here. So here is our course. And right here on the main screen for our class, there's going to be a new folder over here, and it's going to say Tiffanopoly. And that's where I'm going to be posting like the group assignments or the group number. I'll also be posting an accounting framework. So let me just grab this from my other screen here. So I am going to be posting this framework in that area in Moodle as well. So what you'll need to do is either save this as a spreadsheet, just as an Excel file on your own computer, or upload it as a Google Sheet. But what you'll need to do is get your copy of this, because that's what you're going to submit. So this coming back with all the transactions, as well as the completed financial statements, an income statement, as well as a balance sheet. That's what we're after. So what I will include in that initial information is your group number, as well as some initial transactions. So the company sold shares of stock for $100,000. So that'll be in there. The company borrowed $175,000 from a bank. So that'll be in there. And so you'll just need to use this spreadsheet to record those initial transactions, and then we'll start playing the game. So you earned, somebody landed on your space and paid you rent of $1,500. So $1,500 is going to go up in your cash account. Your retained earnings will go up by $1,500. Your rental revenue will go up by $1,500. You land on the space of someone else, and you have to pay $1,200 rent. There goes $1,200. There goes our earnings, our profit, and there goes your $1,200 for that rent expense. Okay. So we'll go throughout the class. We'll continue to have turns, and you'll need to record those transactions as people land on your spaces or as you pay out rent, and that sort of thing. So that's basically kind of what we'll be up to for next week on Tuesday, playing our Tiffanopoly challenge. So again, ideally, it's kind of a fun way to kind of break up a little bit of the monotony and kind of give us a little something else to do, kind of bring some of these concepts that we've been talking about and learning about into full light. So and we'll kind of go over this in class next week on Tuesday, but I'll be posting some of this information to Moodle. So I just wanted to kind of stay ahead of questions, and just so you kind of have an idea of what's coming down the pike. Any questions this morning about the Tiffanopoly? Okay. So then otherwise, looking ahead to next week, our Chapter 9 homework will be due on Friday, 1 week from today. And we'll spend some time in class reviewing that, as well as reviewing and getting ready for our final exam. Okay. A couple of other, like, just general housekeeping items. 2 other extra credit opportunities. So again, many thanks to the folks that participated in the tax seminar Wednesday this week. I saw an email with the winners of the Amazon gift card, and now I'm trying to remember the I know I had one of the winners in class yesterday. Let me grab my email here. Oh yeah, no winners in this class. Sorry, guys. But good news, extra credit. Everybody's a winner for that, as long as you did what you needed to for our class. So again, I was looking for that email back after you watched the video, with a couple of answers to some of those questions. So if you missed that or haven't submitted that, shoot me an email and we can figure out something to do with that. Okay. The other element, or the other opportunity for extra credit, is that you should have received an email this morning about the course evaluations. And so that the course evaluations are now open. So extra credit will be given to anyone that completes the course evaluation. But the only way that I know if you did complete that course evaluation is for you to send me a screenshot showing me that you've completed it, because I never know the names or anything else that's associated with any of that feedback. So again, I'd really encourage you to do that, complete that. It gives me a lot of valuable information about what I can do next time in this class, what worked well, what didn't work well. It also gives Dean Sullivan some very valuable information about my performance as an instructor. It also gives the university a lot of information and valuable feedback about this course and how you feel like this course has gone, just from a pure academic standpoint. So I'll also be sending out a Moodle announcement about that. So I've got lots of homework for this weekend. I'll be a busy guy. But let's see. Yeah, that's my intro list. Any questions about the extra credit, Tiffanopoly, things coming down the pike? Okay, so here's an example. It's kind of small. Sorry about that. This is an example of what you can submit for your evaluation. So once you actually complete it, it'll show a check mark for our class. Or you can just, there's also another screenshot that you can do just after you hit submit that will post that for the class. So again, I'll post a Moodle announcement with that opportunity here shortly. All right, so let's see here. Let's switch back over to chapter 9. Let's finish off this last chapter for the semester. Remarkable to me. Okay, so what we're going to be talking about for the rest of today is ratio. So we're gonna really focus a lot on division. Okay, so we're going to go through lots of formulas, lots of calculations. You'll have all those in the book, in the chapter reading. So what's more important for today's conversation is what are the implications and what do these ratios show us? And what can we see from them, and what can we learn from them? Okay. So as far as the final exam goes, you will be allowed to have a formula sheet from your notes. And so again, the idea there is that I don't want you to be focused on memorizing these formulas. Because really that's not the most important element. That's not the most important thing for you to learn this semester. The much more important, valuable information is how to use these ratios and what they're telling us and what we can learn from them by that analysis of them. Okay. It's important that we know the proper way to calculate them so that we can analyze that information correctly, right? The only way we can know if somebody wins the game is to know how to correctly keep score. And we're coming from the same place as we look at these ratios in this financial statement analysis. So let's take a look first at our liquidity ratios. So we have several different measures, several different ways that we can evaluate our financial performance and our financial position as it relates to liquidity. And again, liquidity, I kind of flashed this up and didn't even really hit on it too much. What liquidity measures is how fluid are we? How quickly can we convert items into cash. That's what we're talking about. So are we quick? Are we fast? Are we liquid like water, or are we a little bit more viscous, or a little thicker, or a little richer, or a little slower like molasses in January? Okay. What's our speed? What's our capability? Okay. All right. So first calculation that we have is what's called our working capital. Okay. What you'll notice about this measure is that we're subtracting. We're subtracting our liabilities from our assets. We're looking at current assets and current liabilities and subtracting those liabilities. So what we're going to be left with is a balance. Okay. We're left with a balance. So let's take a look at, let me get my 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 whiteboard up here. And let's take a look at our balance sheet and see what this is all about. Okay, so we're talking about our current assets and our current liabilities. Okay, remember, we talked a little bit about the idea of current assets versus long-term assets, maybe in chapter maybe 7, maybe 8, probably 7. And what we're really after here, let me go back to my whiteboard, is that our we can talk about current assets, and we can or liabilities in long term. Okay. The difference here is that our current assets are either they already are cash, or they're going to be changed into cash in 1 year or less. Okay, that's what makes our current assets current assets. Long-term assets have a useful life beyond 1 year. Okay. Everybody comfortable with that idea? And I'm kind of like drawing a line right here in the sand, right? Um, I know it's not great artwork, but I hope that kind of helps paint the picture of what we're talking about with current assets and current liabilities. So current, if we're talking about current liabilities, we're talking about obligations that are due 1 year or less. And if we're talking about long-term liabilities, we're talking about liabilities or obligations that are due beyond 1 year. So it's still that 1 year horizon that we're looking at. That's our line in the sand that we're kind of, which side are we on, the short side or the long side, of that particular element. Okay. And does that make sense? Questions or concerns or troubles with the long-term, short-term classification element there? Okay, I'm going to go ahead and just kind of erase this. We've got a lot more to cover in this sheet, so. All right. Okay, so when we look at our working capital, again, what we're focused on is our current assets minus our current liabilities. Okay, so in our example from the chapter reading, we had this data from this company that was presented. And so what we're being told then is that we have a balance left in working capital. So our assets, if we converted all of our current assets into cash and paid all our current liabilities off, we'd still have 122 grand. That's what we're saying in 18. In 17, we'd still have 102,000 left in cash. Okay, so the balance is fine, right? The balance tells us some information, but that, well, that's a little bit of the shortcoming of the working capital, is that this balance tells us something, but what makes it a little trickier is, let's just copy this over here to company B, just as a for instance. Let's make let's do that, and then let's oh, I don't know. About okay. Okay. Which of these companies is the bigger company? Which one of these companies is larger? Company A or company B? A or B? Feel like you're at the eye doctor? Which one is more clear? A or B? One or two? Which of these two companies is larger? Company A or company B? B, yeah, absolutely. Brandon, the king of B, right? Okay. B is larger. They have more assets, right? It's 10 times the size of company A. Which company has more working capital, A or B? Yeah, still B. Awesome. Good, good. So this balances more. This is a bigger company. They have more working capital, right? But what we see here is that it's hard to compare the big company to the little company because they are so much bigger. So we get a little bit of like what I call like a scale problem where we're trying to compare that big company to that little company. Okay. Now, what we'll see next kind of helps us compare those companies, and that's where we're going to get into ratios, proportions. Okay. Our first ratio is what's called our current ratio. Our current ratio, instead of subtracting our current liabilities, we're going to do just straight division. Current assets divided by current liability. We're going to get the proportion. We're going to get the relationship between those two balances. Okay, so no different than a recipe, right? We might make like maybe we make a bread and it has 2 cups of wheat flour and maybe it has 6 cups of, I don't know, rye flour. I have no idea. Okay. What we're seeing is that we have a 3-to-1 relationship, 6 divided by 2, which is a 3-to-1 rye to wheat. Okay. That relationship, that ratio, that proportion is what we're after here. Okay. And so we don't care if we make one batch or 100 batches, this 3-to-1 is going to remain constant, right? So if we're making one batch of this in our kitchen, at home, or if we're Aunt Millie's flour or Aunt Millie's bakery, and we're making 1,000,000 batches of this bread, okay? This proportion, this ratio, it doesn't matter. One batch or 1,000,000, that proportion is going to carry us through. So if we look at what's called our current ratio, what we're doing then is we're dividing our current assets and comparing that and seeing what's that proportion as it relates to our current liabilities. So what we're looking at here for Company A in 2018 is that their current assets are 6.5 times more than their current liabilities. If we do the same for Company B, we see that their current assets are only 1.22 times larger than their current liabilities. They have more working capital, but as a proportion, they're not as healthy. They're not as quick as Company A. Do you guys see that relationship there and what I'm kind of getting at with that relationship? Is that making sense for folks? Okay. Nice, Garrett. I like it. All right. So, kind of to this point, okay? Here's a poll question for you guys, real quick. Who had a better football team in 2019? Tiffin University or the University of Michigan? I know what Brandon's vote was. At least I hope I know what Brandon's vote was. As long as he voted. Okay. What I guess I'm kind of getting at here with that question is that the University of Michigan, their record overall was 9-4, and they were 6-3 in their conference. Okay, TU won the conference, Okay, so from that perspective, if you're just saying, well, what about in the conference? Well, TU won the conference championship. They had a better season. Well, University of Michigan might beat Tiffin University if we drove up to Ann Arbor and played them, right? But the idea of so they might have they might have higher working capital. Yeah, we'd have to play the game, right, Brandon? We're not sure who would win, right? Okay, so that's the idea of what our relationships and our ratios tell us is it takes the bigness out and it puts everybody kind of on the level playing field. Here I'd say, yeah, that's peanuts, 120 grand compared to 300, but it's a much stronger position that they're in. Okay. All right. So let's take a look at our next ratio is what's called our quick ratio. Okay. The idea behind our quick ratio is that we're taking a narrower look at our asset side of things. We're narrowing up that assets that we're including. And so what we're basically doing is we're excluding our merchandise and we're excluding our inventory and our prepaid expenses. We're narrowing up this look here on our asset side. And here's the reason why this is important. Okay, most large companies, right? We have two different cycles that we're completing here, right? In order for us to get money out of our inventory, first we have to sell that inventory. If we're selling it on account, first we have to sell it, and then we need to collect it from our account receivable. So it's like a two-step process to really convert this inventory into cash, which is what we're all about in our liquidity measures. Is what's our process? What's our timeline? How fast are we? How liquid are we? How long does it take us to make this into cash? Okay. So what our quick ratio does, we have our quick assets, which is current minus inventory and prepaid. Okay. Again, I don't want to get hung up on the formulas and the math and all that because you'll be able to have your note sheet there. But the idea of what it is and why is it important, that's far more relevant to us today and throughout your career. So our quick assets here was 94,000 and 98,000. Okay, so just like our current ratio, we were dividing our current assets and our current liabilities. Here, our quick ratio is going to be our proportion of quick assets in relation to our current liabilities. So again, we're seeing that slightly less, right? And that's because we're narrowing up, right? We're putting a shorter list of things in there, right? Does that make sense? Any questions or troubles, or how did we get to any of those numbers? Or again, we're going to throw around. There's going to be lots of division, lots of numbers swirling around today. So if any of them give you cause of concern, throw your hand up, throw something in the chat box. You gotta pull my reins one way or another. Okay, so Levi, on the quick ratio, the actual formula is the quick assets divided by our current liabilities. So what we're seeing here for this company is that our quick assets are just a little bit more than twice the balance in our current liabilities. Perfect. Very good. Okay. So next up, we have some really good. I like our these turnover ratios because they give us so much information, so much valuable data or valuable information for our company. Okay, we can really learn a lot by looking at these relationships. And so what we're looking at here in our turnover ratio is our accounts receivable turnover ratio. We're looking at our net credit sales, and we're dividing that by our average accounts receivable balance. So let me switch back over here to my whiteboard here. Okay, so here's our formula. Net credit sales divided by average accounts receivable balance. Okay. So do we have any, I know we have track runners in our class, but is anybody a track superstar? Do we have any track superstars with us this morning? Brandon, you're a football guy. Haley, you're softball, right? Oh, nice. Yeah, I know Drew. Yeah, cool. Okay. Well, okay. So have any of you guys ever heard of these like super ultra um race events where some of them are like on a mountain bike or some of them are just like a trail for running, but where the race is it's a 24-hour clock. So at 11 o'clock this morning, the race started, and the competition is who can go the farthest by 11 o'clock tomorrow morning. It's a 24-hour race, and the winner is whoever goes the farthest. Have you guys ever heard of these super endurance races? Brandon hasn't. Has anybody ever heard of them? Yeah, kinda. And yeah, Levi ultra marathon. I've sometimes heard of an ultra marathon too as like a 100-mile race, or as a 62, um, like 100K or 100-mile. And so the idea behind this is that there is no distance to the race. There is like the finish line is just time. Okay. So it's like how many laps can we do? So the idea, if we wanted to kind of like boil it down to a simpler version, it'd be like you and I, Levi, we go to the track in the Heminger, like when we're allowed to go in there again, and somebody sets a clock for 10 minutes, and it's just whoever's further ahead at the end of the 10 minutes, that's who wins the race. Okay, does that make sense? You guys kind of see what that idea is? Who gets the most laps? Okay, so that's what we're looking at with our turnover ratios, is how many times do we complete this cycle or this process over the given period of time, most typically a 1-year period. Okay, so when we look at our data set here, I'm just going to pull that up and then just toggle back to our whiteboard. Okay, our sales, our net sales for our company was 900,000. for 18 and 800,000 for 17. And then we have a beginning balance of 56,000 and 50,000 as a beginning and an ending. And here we have 55,000 and 56,000. So if we wanted to look, we need our average balance of our accounts receivable. We were given a beginning and an ending balance. How would we calculate an average balance? What's the average of 56 and 50? Okay, Angela, you've got 53,000. So did you just see what's halfway in between these two? Or did you do the real average number? Okay, so the easy way, right, is that 53 is halfway in between, so that makes it the average, right? The other way that we can do this is 56,000 plus 50,000 and divide that answer by 2, right? And we can get to the halfway point or the average either way, right? But what's important is that we calculate that average. Okay. Same thing here with 2017. Okay. So our beginning plus our ending, we have 2 points of data. So we're going to divide it by 2. If we had 3 or 4 points of data, if we had 4 points of data, we divide it by 4, right? No different than your GPA. You had an A in accounting, an A in econ, a B in English, right? So if we want to find the average, we add up those items plus this, and divide the whole thing by 3, and there's our average GPA, right? 3.67, okay? So however many things we have divided by that number, okay. So now that we have the average balance and the sales, now we can do our division of looking at the relationship between our sales number and our average balance in our accounts receivable. So our ratio, our turnover ratio of our accounts receivable balance is our sales divided by our average accounts receivable balance. Okay. What this means is that if we were to make sales on account and then get paid to nothing, and then make more sales on the account and then get paid to 0, get paid off by those customers, if we constantly went from a balance to nothing, a balance to nothing, how many times would we do that during the course of the year? Okay. Now, of course, that's not what actually happens, right? Our balance is constantly moving around, but we're constantly adding and getting paid and adding and getting paid. Okay. But what this is telling us is that we're completing the cycle. We're completing this process. We're doing this 17 times over the course of this year. Okay. If we looked at 2017, we could do the same division and see that we're completing more laps in 18. So we're collecting our accounts receivable better in 18 than we were in 17 because we're doing more laps. Does that make sense? You guys see that relationship there? Okay. So the other element here within our liquidity ratios is converting this turnover ratio into an average collection period. Okay, that's what it's called. It's called the average collection period. But all we're going to do is convert this turnover ratio into a day count. So if we do this 17 times in a year, how many days does it typically take to complete that cycle, that process? So all we're going to do in our average collection period is take the number of days, which is 365, right? The days in the year, and divide that by our turnover ratio. So what we see in 2018 is that it took us about 21 days to collect our balances from our accounts receivable customers, which is faster by about 4 days compared to what we had in 2017. Okay. Does that make sense? Do people see the math there? Questions or troubles with the math there? Any of the formulas or anything? Good, bad, ugly? Sure. Okay. Levi asked the average collection period formula. It's 365, the days in a year divided by our turnover ratio. So what we're doing there, Levi, is we're going to do this 17 times in a year. So we're converting that into days. So that's why we'd see that's going to be less than a month, right? If it were 12, it would be 31 days, right? And since it's more than 12, it's kind of like inverse. It's that inverse relate. It's that opposite. The bigger this number, right? The smaller number of days. Okay, very good. All right. So if our credit terms to our customer were net N45, what does that term mean? N45. What does this mean? N45 in credit terms to our customers. What are we giving them? What are we asking them to do? If our credit terms to our customer is N45, what's that credit term telling us? Maybe it was too long ago that we hit this. Does anybody remember? Wayback Machine? Okay. What it means is that the net or the total amount is due in 45 days. Okay. That means we're giving our customers 45 days to pay us. If our average collection period is 21 days, are we doing good or are we doing bad in collecting our accounts receivable? Yeah, absolutely, Levi. We're doing fantastic. Our customers are paying about 14 days, no, 25, 24. They're paying 24 days early. That's fantastic. That's great. Okay. So that's what that turnover ratio, that's the data that we're given. That's the information. We don't have to go through our accounts receivable and track every customer per se, right? We're going to look at the whole thing and kind of get this relationship so we can kind of understand what's happening in that account. Okay, this is cool stuff. All right. So next up, we have our inventory turnover. Okay. Our inventory turnover looks very similar to our accounts receivable turnover. Our inventory turnover calculation is cost of goods sold divided by our average inventory balance. Okay, we're looking at a very similar type of approach here, but now we want to understand what's happening in our inventory account. Okay. So let me just get us some data here. And let's take a look at some math here. So our cost of goods sold was 610,000 compared to 480,000, and our beginning balance 43,000, our ending balance 70,000. We're going to need to calculate the average inventory balance for 18. So I'm going to pop a few more numbers in here, but if somebody could help me out with what this average balance is or how we would solve to get that average balance, that'd be great. How do we calculate the average balance, our average inventory balance? It's not as easy, Angela, as just splitting the difference, right, and finding the halfway point. It's almost that easy, but not quite, right? It would probably be easier to do some sort of formula to get that average. So what would be our formula? What do we need to do to get? Yeah, add it up and divide it by 2. So we could do that. We could do sum of this divide 2. Okay, so that gets us there, right? So the sum of the parts divide by 2. We could even, if we're in Excel, we could actually even just do average if we wanted to be really lazy. As long as we know how to spell average. Wow. Okay, equals average of those two, and we get to the same number. Okay. So add them up divided by 2. If we're in Excel, we can just use our average formula. No wrong way to eat a Reese's or a Reese's Easter egg. Delicious. Okay. All right. So back to math here. So what is our inventory turnover ratio? What is that turnover? Again, what we're looking at here is if we were to buy inventory and then sell out and then restock and sell out and restock and sell out, how many times would we do that over the course of the year? Okay, so that's what this ratio is doing. That's what the data is that we're going to get for our answer. Now, that's not really what happens in business, right? Although if you go into a grocery store, it might look like that's what's happening right now, right? You know, there continue to be out of stock on some things, so they must be just reordering and selling it all, right? But that's what this ratio, this inventory turnover ratio is telling us. So we're going to divide, we're going to take our cost of goods sold and divide that by our average inventory balance. We're going to take our cost of goods sold and divide that by our average inventory balance. So we are completing the lap of completely selling our inventory. We're a bit slower here in 18, right? We went from 11 and a half down to under 11. Okay, so this turnover, this cycle, this process is getting slower. We're not as fluid as we were in the year before. Okay, again, if we take that to the average sales period or the days it takes us to complete this process, again, we're going to take our 365, our number of days in the year, and we're going to divide that by our ratio, our turnover. Okay. This should be more than 30 because we don't do it 12 times. It takes us more than a month to do this. Here last year, we were really close to being 1 month. So this one should be right around 31. Just a little bit slower. And there you go, 31 and a half. What does this mean? What does this average sale period mean? We can look at it a few different ways. One of the ways we can look at it is this is how much stock we have on hand on average. So what we're saying is that we have about 33 or 31 days of stock on hand. Or it's going to take us about 33 days, almost 34 days, to sell all the inventory that we have on hand. If we are looking, let's just say we were looking at the produce department for a grocery store. Are we excited that we have about a month's supply of carrots? It's going to take us about a month to sell all the carrots that we have on hand. Is that good news or bad news? Yeah. I'd go one step further there, Emma. Let's see if I can get the right emoji here. Yeah, I think this is the one I was looking for. You know, carrots after a month, right? Milk after a month. Pretty bad news, right? Okay. So again, this turnover ratio tells us that process, that cycle, okay? What we're really after here too, just an aside, although we're kind of running out of time, RPMs on your engine, revolutions per minute, okay? How many times does the engine turn over? How much work are we doing, okay? That's what our turnover ratios are all about, okay? All right. So we've hit that. So on to solvency questions, solvency ratios, okay? What we're going to look at here are a few different solvency ratios that tell us the relationship, again, our ability to make payments on our debt. Okay, so our first item, our first ratio is our debt to asset ratio. These formulas are pretty easy because the formula's in the name. Debt, liabilities, to assets. So we have to look at our obligations compared to our assets. Okay, so let's take a look at our data set here. And let me just go back to our handy dandy whiteboard here. So our assets were $508,000 or $465,000 in those 2 years. Our debt was 146. Our liabilities was 143. I'm going to jump the gun over here and just come back to our whiteboard. Okay. Do we know here pop quiz? How much equity do we have in this year? This is 2017. How much equity do we have? Our accounting equation, oh no, this was 2018. Our accounting equation will tell us. We have assets minus liabilities. So in this year, we have 362,000 in equity. And in 17, we can still use our accounting equation to have $322,000 in equity, right? So our first solvency is our relationship of debt to assets. So we're going to divide our debt, our liabilities by our assets. What we're saying is that about 30% of our assets have a liability that is kind of like encumbered. It's kind of like covered up by a liability. About 30% of our assets have an offsetting liability, we could say. That's what that relationship is showing us. Let's take a look at the calculation for our debt to equity, and then we'll look at some relationships as to what happens when these things change. So debt to equity, so debt, liabilities divided by equity. It tells us that we have a 40% relationship between our debt and equity, okay? What we want to see to make sure that we're solvent, to make sure that we have the ability to pay on these obligations, is we want to make sure that if we lower our debt, okay, just as a for instance, if we lower it by $100,000, what we see is that our debt to assets drops significantly. There's less risk involved, okay? If we add more debt, there's more risk involved, and our debt to equity actually goes above 1. It goes above 2. So the more debt we have, the more risky we are. And that relationship is what's driving those calculations. Okay. So then our next formula, well, for any does everybody kind of see what's happening there in those formulas or in that math? Any questions about those formulas there? Debt to assets and debt to equity. Okay. Our solvency kind of wraps up with our earnings before interest and taxes. We're going to divide that by our interest expense. So within our data, we're going to look at our income before interest and taxes and compare that to our interest expense, what our interest expense was. Again, the larger that number, the more able we are to be able to make those interest payments. And so that kind of makes our bank happy. The better able we are to, the bigger that the bigger that relationship, the more the stronger we are as a company. Oh yeah, I'm sorry. We do have one more solvency ratio, and that's our long-term assets compared to our long-term liabilities. Again, we're just looking at this relationship between the two balances, okay? So we want to just look at our balance sheet, look at our long-term assets and compare those to our long-term liabilities. Again, we're looking at the longer vision here of being able to make good on those long-term debts compared to our long-term property, plant, and equipment. Again, this is kind of like our endurance element. This is kind of like our speed up here, right? Our current is kind of like our short-term sprint, but then this long-term is kind of more like our endurance. How much staying power do we have? Okay. So our profitability measures, really the formulas are there. We're kind of running out of time. I'm sorry about the rabbit trails today. In that we have more calculations, but what we're really after here is I kind of view our investments as our seeds, and then what are we harvesting? What are we growing as a result? Okay, and that's what our profitability measures are looking at. Here in our first net margin ratio, we're taking our net income, kind of our bottom line of our income statement, and we're dividing that by our sales. So how much income are we generating based on our sales? So what's that proportion? How profitable are we? How much net income do we actually gain by each dollar in sales that we generate? Okay. Our next is our asset turnover. This is comparing our sales to our assets, our total assets, our average assets. Okay. Again, I kind of view our assets as our seed, as our investment, as how much money we're putting down on the company, and then what are we harvesting as a result of that investment. That's what this asset turnover ratio is really focused on and driven on. Okay. A couple last elements that we're going to calculate here in Chapter 9 are return on our investment. So our net income as it relates to our average total assets. So again, this is kind of from the company's perspective. Our ability to generate profit based on what's been invested in the company. And then what we see in our last calculation is that all we're doing here is changing this to equity and this to equity. So we're still comparing our net income, but we're comparing that to our equity. So this is kind of like an owner measure of our profitability. This is what the owners have invested, where our return on investment here is more from a company perspective of the assets that we've invested in from a company perspective. Okay. Again, sorry that some of the formulas were kind of quick there towards the end. All again, the formulas, you can create your formula sheet. You can use that for the final exam. I don't want to get too hung up on the math, but more importantly about the relationship that we have within those different elements. Okay, again, it is very important that we do the right math steps. But ultimately, what is that information that we're learning by by looking at that actual relationship within that ratio? Okay, I know we're at time, so I just want to kind of button it up. I can stay on the line here for anyone that wants to hang out after class here, but otherwise. We will have our Tiffanopoly challenge next week on Tuesday morning. Watch for Moodle announcements and things coming related to that. Make sure that you get that framework downloaded, that you have it ready. If you want to keep it by pencil and paper in class, that's fine. But just know that what ultimately will need to be submitted is that spreadsheet coming back with your financial statements and all your transactions recorded. Okay. Next week in class on Friday, we'll have our homework from chapter 9 that will be due. We'll spend some time reviewing that, as well as preparing and reviewing for our final exam, which will be coming away Thursday, about, well, 2 weeks from yesterday, right? Okay. So I will end the recording here, and